It's my pleasure to have with us today Adib Motiwala of Motiwala Capital. Adib, welcome.
Thank you, John.
I really enjoyed looking at your website, and I recommend everyone to check it out as well. It's motiwalacapital.com, and there you have a presentation about your investment philosophy. But before we delve into the philosophy, could you just tell us a bit about your background and how you became a value investor?
Okay, sure. So my background is not the traditional background of many investors. So I started out as a computer science graduate back in India. I did a bachelor's in engineering. Then I came to the US in '99 to pursue my master's degree in computer science. So I graduated in 2001 from Texas A&M. And then I started working as a software developer in Dallas, and that's where I've been for the last, I guess, 10, 12 years. So always been in the IT industry, but I always had a interest in investing in finance from back home. When I was a little kid, my father and my brother would always, invest in stocks. And back in India, we would fill out the IPO application forms. Where in India you can participate, and you can there's a lottery system. So I used to fill those forms out, and it was always interesting to see the stock prices in the newspaper, and so I always had an interest there. And even when I came to the US, I had a little bit money saved during my degree, and I was investing during the .com period, so buying all technology stocks because I was doing a major in computer science, so I thought I should know a lot about computers and technology more than other people. So that was my kind of start in the US. That didn't go down very well. Obviously, I picked a lot of stocks that went to zero, or even the high flyers like Cisco and Microsoft, Intel. They did well initially, and I was looking very smart when they were up 50%, and then over time, they all came down crashing to earth. So I didn't know what. So that was the initial start, and then really didn't have any philosophy as such. Then I worked on my MBA in 2007. I started my MBA, and during the MBA, again, we learned a lot of theory about finance, but not really investing. And then finally, I read up some books about value investing, obviously the Intelligent Investor, and Bruce Greenwald's book, and then reading some blogs, and that's how I got hooked onto this, and just learning and reading and doing it by myself and making mistakes. That's how I've been learning.
And what I found fascinating is in your presentation you actually say, and I quote, that you were a clueless speculator until the fall of 2009 and have been a value investor since the spring of 2010. Was there one specific event or mistake that kind of caused you to turn to value investing?
No, as I said, I didn't have any good success. I had mixed results with my investing on and off from 99 to 2009, which included two crashes and some boom periods, and so didn't really have any real philosophy. And then as I started reading, that's when I met a famous value investor, like a modern value investor, Zeke Ashton. I met him around the March of 2010, and I asked him how one should go about doing well in this profession, and he gave me some ideas on what one should do, and that's where I started following his advice. So that was a switch.
Well, Zeke is a great investor and a member of the Manual of Ideas, and so I think you were very lucky to come across him at that time. Tell us maybe a bit about, once you were turned on to value investing by Zeke Ashton, then what did you do to actually really get educated? Are there any books that you really enjoyed that you would recommend to other people who want to get started in value investing?
Sure. So one of the things he told me was to read, the annual reports and the 10Ks and the 10Qs and the filings, the call transcripts, understand the business really well, and then write up the research reports or your ideas on a blog, exchange ideas. So keep learning basically rapidly. So that's what I started doing. I picked up a few companies every month, which I would want to research, which had a little bit understanding or I had some interest in, and then I would read the annual reports and try to write up if I believed that was a good idea, I would write up a small report on that. Some of them I published on my blog or on other websites, and I would also send them out to my friends or anybody who would give me feedback. I would send it out to many buy-side analysts or even fund managers. I wouldn't often get a reply. Sometimes I would get some reply, and I sent many of them or all of them to Zeke, and he was very kind enough to give me feedback on them as he saw fit. So that was a kind of the start of doing things, just getting started with doing the research, writing my ideas down, getting feedback, and then I would follow it up by buying some of the stocks that I had belief in, and then see how things go, because that's the only way to learn is, you do the reading, fine, but you have to follow it up. You invest some of your money, and then you see what works for you, what kind of ideas are working, what mistakes you're making, and learn from those mistakes. So from 2010, like March, April, I started also investing money into my ideas based on my research.
And
and I would basically read up books, some books, but mostly a lot of blogs. Read up the letters by different managers when they would write their quarterly letters. Read up their thesis, all these presentations, conferences. There's so much material out there, not enough time, in fact. So I would just read up things to see how they're analyzing different companies, what do they like attractive, what is their common philosophy that some of these, the most successful investors were talking about, and see what kind of made sense to me, and pick up ideas from everyone.
And you talk about your circle of competence in your presentation. I think that's obviously a key concept in value investing. Buy what you know, do your own research, don't invest in an area just because everyone else is doing it, and over time you can increase your circle of competence. Can you tell us a little bit about how you view your circle of competence, given that you started out in technology, and has it evolved in the short time that you've been a value investor?
Sure. I would say I would consider myself, as a generalist. I wouldn't say I'm an expert in any particular area. I have working knowledge of writing software systems, so I understand that. Software services, sure, I understand that. Technology is kind of very broad. From hardware, software, services. Broadly understand it, but I wouldn't say that I invest most of it there. I kind of look at it many other areas to see what's interesting. So retail has been one area that I find fascinating or interesting, and relatively easy to follow. When you have stores you can visit, you can see what people are buying. You have friends, families. You can do that kind of research relatively easily. So I like retail. So mostly specialty retail. I have about 3 or 4 stocks that I've bought over time, and I think restaurants, retail. So those kind of things are interesting. But I've also done other investments recently in areas which I don't like. I wouldn't say I'm an expert in, but I start with obviously trying to understand what they're doing. Is it simple enough? The numbers are appealing. The management is doing the right things, and they have done over time, both in the business and also the allocation of the capital. So that's kind of the basic things. And then what I'm doing is I kind of try to avoid areas which I have no interest in, or I want to avoid them, which have not done well. for example, airlines typically have been a losing business, so I avoid that totally. And then similarly, I avoid banks. Quite complicated, I would think. Much more simpler business out there. I'm not saying you can't make money there, but it's more leveraged and there are more black boxes for me right now at where I am. So I'm just kind of, just be honest with myself and see, okay, do I really understand this better? And if not, then I don't want to go into those areas. So kind of eliminate some of those things and then look at what's left over and then see if those are good businesses. So I don't know if that's a great answer.
And you also talk about risk and the need to avoid it and kind of the tortoise versus hare metaphor. So how do you avoid risky investments?
Okay, that's a good question. So I think the first thing that you can do to protect yourself is, I think firstly you should understand the business. That's one level of risk. So if you don't understand the business very well, the nature of the business, how it makes money, how it does in different cycles, so avoid those kind of business which you don't understand, or they're going to be difficult to predict, and where you have to rely on the timing. So that's one level of risk. The second is the company itself. Is it a very levered entity? Does it always take on a lot of debt? How's the balance sheet? Just simply. So if you don't have too much debt, it's a good clean balance sheet, well covered. If it has some interest, based on the stability of the cash flows, if it can service the debt. Ideally, you don't want. I don't like debt, but if they have debt, it should be easily serviced with the cash flows. So that would be one more elimination of risk, the balance sheet, and then again steady cash flows. So you want something that may not be always the same level of cash flows, but reasonably steady and predictable, and so that is always good when you have free cash flow left over. Then good things can be done for shareholders. So that would be the other thing, I would say.
And then when it comes to the valuation, obviously buying things cheaply.
Actually, sorry to interrupt you. One more point. Just the third part is the capital intensity of the business. So I mean, there are some businesses which have good cash flow, but they have to constantly reinvest in the business, and whether it's buying new equipment or set up plants or whatever it is. So capex eats up all of the cash flows, and not anything is really left over. So that can be another level of risk. And if it's combined with leveraged balance sheet and high capex, those two things are good together, don't make a good combination. So avoid that combination.
So just to follow up on that, do you then avoid a lot of oil and gas companies, for example, that do plow back a lot of their cash flow into exploration?
I did make an investment in one oil service related business, ENSCO. That was back when the BP oil spill happened, and a lot of those companies were beaten up, and this one was not directly involved, though there was going to be some impact from the regulation, and it had a clean balance sheet at that point. There was always some capex, but it had a good balance sheet and free cash flow. So I did make that investment, and this is, again, you have to realize this is very early into my learning stages in 2010. And eventually they made a big acquisition, so the clean balance sheet went away, and heavy capex continued. So I eventually got out of that investment with good gains. But that one was more because it was really beaten down and there was more pessimism. But I want to be avoiding them as much as possible. Even if I make those investments, they would be a really small part of my portfolio. Right now, I don't have any oil and gas related investments.
And you have a very interesting slide in the presentation on your website that says, why do stocks become cheap? And I think it's interesting because it helps us understand some of the reasons why companies can become undervalued in a market that academics say is efficient. But you, for example, one of the bullets is neglect, and Microsoft has been dead money for a decade, maybe not for the past few months, but before that people said, yeah, it's very cheap, but there's no catalyst, so why should I buy it? And then it goes up 50% in a few months. So maybe tell us a bit about sort of the types of situations that you have found most interesting or most rewarding because the market gets them wrong.
Yeah, I mean, I did make that investment in Microsoft, so I kind of did well with that, and I also made investments in like Intel and Cisco. Some of them were in my personal account, but so yeah, I mean, neglect probably from investors is a common one, and then sometimes it's just plain cheap. And like last year, I bought this company, Big Lots, and I think there was probably a private equity deal that didn't go through, and the stock came down a lot, and it's a really good business with good cash flow, and it was reasonably cheap, about a 10% yield on free cash flow ex cash. There was no really catalyst inside, but I just checked my things that I look for in a business, good free cash flow, good balance sheet, good management, stable business, low capex, and good profitable track record for many years, and it had everything in there. So I just bought it, and after a year it was up 40%. So typically I don't look for catalysts. I don't think, at least where I am, honestly, if I can identify them that easily, then a lot of people would have already seen them. So I don't go looking for them. Something emerges, that's fine. I think basically, like, patience is the main important ingredient that individual investor or small investors have on their side. So just be patient with good picks. If they're good, cheap, safe companies, you hold them 2-3 years. I think that's enough time for it to make a move. Small caps, I mean, that's a common one. I mean, I own a couple of them. They seemed cheap for a while, and then eventually, they went up. There was no real big change as such. So, they can be out of just, not many people looking at them. That could be it as well.
Now, in your Q1 letter, you actually talk about 4 new investments that you made: Lear, Tesco, Iconics, and Halfords. I'd love to just delve a little bit into some of those, if that's okay with you. And in particular, maybe we could start with Halfords. How did you find it, first of all? It's a UK company, and then what attracted you to this company?
Sure. I believe I've seen it even a year ago. There was a write-up I believe I saw. Maybe Vitaly Kettleson wrote about it. And then also it was in some screens that I used to run, but I never invested back then. Then again, I don't know where I don't remember where again it came to my mind. Maybe I read it on a blog or something, and then I started doing the research on it, and I really liked the business. So I think it was a combination of, I'd seen it in the past, like a year ago, and then saw it again. I just can't remember where I saw it this time, but this time around I actually took the time to do some research on it. Read up about it and see what kind of business is it. Is it an attractive business? And the valuation seemed really attractive. And I like the management, where they are returning 50% of the profits to shareholders via dividends, and they were also doing an aggressive buyback last year. So it seemed like a steady business. Is out of favor. It probably will remain out of favor for a while, but I think shareholders will do well as they're getting paid, a good dividend yield, about 7% or so, and business is profitable. Debt is reasonable as well.
So the dividend yield of 7% is obviously very attractive, and it sounds like you based on your analysis, are confident that the dividend can be made from the cash flows and maybe will even go up over time?
Yeah, I think the dividend payout is about 50-55% when I last checked. And even though margins have come off this year, they have run the business well for cash flow. Cash flow hasn't dropped drastically. And I think with that kind of payout, I think they can maintain it. Speaking to the IR person there, in whatever I read on the transcript, it seems like the first priority is maintaining the dividend, and the buybacks which was done, this last year, financial year, was not something that is going to be recurring or may not be at to the level it was. I think they probably bought 7-8% last year. That may come down, I mean, if they have to, but the dividend is the priority for them. At 50%, I think it should stay there, if not grow. And they have grown it. If I see the last 5 years, they have grown dividends by 10% a year on average. So they have been returning money to shareholders consistently. It's not like based on 1 year track record of dividends.
Halfords, of course, is the UK's leading retailer of automotive and leisure products. And what is it about the business itself that you like in particular?
So I think it has a leadership position in most of the retail businesses that it does. Like, it's the leading position in it sells bicycles. It has leading business like 25% market share. That is one of the things. And then they obviously sell some car parts, more for individuals, not for the garages or the repair guys. But they do that, and that's pretty stable, steady business, and they have good margins there. So I mean, it's growing steadily. There is and they have a service element as well, which a lot of competitors may not have, like a Tesco or the Walmarts in UK, or they have stores there. So they will also fit some of the parts for you. So that is an element which is attractive, and that's growing as well. So people will buy some parts from them and get them to fix it for them instead of doing it themselves. So there is that service element which gives them some differentiation. So they also repair bicycles. They sell service plans for the bicycle repair and parts. So they have some of those elements which are really attractive. Yeah, and then they've bought a business in 2010 for auto repair. So they've bought about 250 car repair centers, which is only 10% of their business right now, and they have only 1% market share in the UK. I think the UK is like it's a pretty big market for auto repair, and they are planning to grow that business by opening 30 auto repair service centers a year. So there is that will grow eventually over 5 years. I think that business will do well. So there is some room to grow. They have a steady business, stable cash flows, shareholder friendly management, because they pay out the dividends, they do buybacks, and the capex is relatively low. Even for a new center that they are opening, there's a 3 to 4 year payback on those centers. It's pretty low capex to open those centers.
Another company that you mentioned in your recent letter is Lear, which was a favorite of some value investors even prior to their bankruptcy. Now Lear has come out of bankruptcy, I think 2 or 3 years ago. Can you tell us a bit about what the balance sheet and the company look like now, and why you like it?
Sure. So they came out of bankruptcy with a really good balance sheet. They had done some of their operations and plans. They consolidated some of the businesses. So now mainly they are not mostly like a global supplier of automotive seating, most of the car makers worldwide. And then they have another smaller division which is growing rapidly electrical power management systems. So those are the two businesses. So the market cap was about 4.5 billion, and they had a cash of 1.6 billion, and they have some debt, 600 million. So net cash was about $1 billion. So enterprise value is like 3.5, 3.6 billion. Last year they had about 450 million in free cash flow, and they started paying a dividend. It's a small dividend right now. It's only yielding 1% or so, but they bought back a lot of shares as well, and the management has outlined their capital allocation very clearly. They're going to pay out the dividends, probably grow it over time. I think there's room to really grow the dividends because it's a very low payout right now, probably 10% payout. And they're going to do the buybacks as well. So they're returning the excess cash to shareholders, and then they're also growing in Asia and in other countries where there is room to grow. So they're opening plants. They have some joint ventures in other countries as well, and their margins are improving. So there is some room to improve their margins as well, and their sales are growing. They're returning. They have good balance sheet. That's very important in this cyclical sector. So it's not something very predictable. Of course, it's dependent on the economies of all the countries where they're, on their supply, on their customers which are making the cars. So you have to be mindful of that. So given that they have gone through bankruptcy, I'm hoping that they've learned some lessons, and they've come out with a strong balance sheet, which is a must in this kind of industry. So that was the main attraction to them, that they have the clean balance sheet, they have good level of cash flow, and the management is doing good things with the money. Those three things combined, and the low valuation, obviously it's 10% plus yield on the free cash flow, made it interesting. And then the kind of, you can say, a macro theme or a tailwind is like cars in the US are older. And actually, if you've been following the auto industry, the sales have been improving over many months, including the last one that came out this year. So that's kind of a tailwind for them. More cars being sold will definitely help them out. So those are the kind of things that attracted to me to this business.
The average age of cars in the US is about 11 years now, which seems pretty old. Do you by any chance have the data on what kind of the historical average is, or what the number is in some other developed countries?
No, I haven't looked at the number, what the average age is in other countries. I haven't done that part of research yet. It's something ongoing for me, given it's a new idea. But I would say, I mean, it would be pretty much in that same kind of ballpark, given that a lot of the developed nations had bad economies, and they probably will still not grow very fast, especially in Europe. They have a big exposure in Europe, about 40%. But as cars get older, you have to go to work, then you have to buy cars. But this kind of yeah, sorry.
No, I was just going to say I had one car that lasted about 11 years, and it was pretty much falling apart at that time. So okay. I'm not surprised if the replacement cycle picks up in the U.S. If that number is really, that if that's the number right now.
Right.
And do you Lear has about $1 billion in excess cash. They have been buying stock. Do you think they're also considering acquisitions, or do you think that excess cash will be deployed into more share buybacks?
I think they will be doing combination of everything. I think they will probably grow the dividend over time. They will be doing buybacks. They have announced another buyback, so they have about, I know, 400 million left in their buyback. I think they plan to do it every quarter, which is good. And then I think they would be doing investments in Asia and other countries to grow their electrical power systems unit. So whether it's acquisitions or just partnerships, but they will be investing in the business as well. So they will be doing all of the things, I think. Not all of that cash is coming right back, and I would probably want them to keep some of it, as a safety net in this kind of industry.
And do you think we are in the lower half of the cycle in terms of the auto and auto parts industry? Where are we just in terms of the cycle? It's a very cyclical business, so I think ideally you'd want to buy these companies when they are in the lower part of the cycle and are pretty cheap. Is that where we are right now?
Yeah, I'm not sure if it's in the lower part or mid part. I'm not very good with on that, but from just the numbers in the US, they are still on the improvement part. Like the analyzed number for cars sold in the US has been increasing, and it's still not reached the prior peaks. And I'm not sure if it's going to reach the prior peaks, but it has certainly, it's definitely more than halfway there from the lows that we saw in 2008. So it's definitely not in the low part, but it's also not in the highs. I would say in the middle, probably in the middle of the cycle.
Another company that I think is very interesting that you mentioned in your recent letter is Iconics Brand Group. It's come up on a number of screens that we've run looking at free cash flow generating companies. It doesn't really have tangible assets because it owns brands. So that's always a dilemma for a value investor when you have a company that has negative tangible book value but is generating very, very strong free cash flow. What gives you the confidence that this company will continue to generate and maybe even grow free cash flow in the future?
Yeah, I think maybe the reason I made this investment is I looked at the nature of the business is such that it gets, buys assets, or rather buys these brands, and then licenses them out and gets royalty income. And they have done really well since the last 5 years. Previously, I think they had their own brand and they were doing their own manufacturing and all of that stuff, and they really didn't go anywhere. And then when they changed the management, they changed the business plan and totally got out of the manufacturing and just went into the royalty or licensing business. And they have done really well since then. So they've got a good track record of several years of buying these brands at reasonable valuations, and then having these retail partners, and their partners are all pretty big partners like Walmart, Target, Kohl's in the US, and then they have international partners as well. They have some joint ventures in other countries, like in China. They announced a joint venture in India recently. They probably go after Russia, Brazil, those markets as well. So I like the fact that they can get this brands and they can have partners in different countries, so they can grow from 4 different ways. They can obviously they can acquire new brands with the cash flow that they're generating, and license that out, and then they can have partners in new countries, in new geographies, and then sometimes for the same brand they come up with their partners come up with different product lines. So whether it's clothing, apparel, shoes, so they can grow that way as well. And then if the sales for those grow, they get incremental income. About 3% is what I calculated that they're getting revenue on those sales. So their partners have about 12 billion in sales globally, worldwide, and their revenue is about 370 million. And you can see the cash generation. I mean, it's 50% margin on free cash flow. So it's producing good free cash, though there is the risk that they have taken on some debt over the years, and right now it's still okay. It's a little bit more than what I like, but it's still okay for the nature of the business. They produce very good free cash, so they can service it. So I wouldn't want them to take on a lot more debt than what they have taken, and hopefully pay some of it down, and just keep doing what they're doing. If they can just get this kind of level of free cash, then in 2 years with the free cash they generate, they could pay off the debt, or the net debt could be zero, and that value will then accrue to the equity holders.
And is it the case that they actually own some of the brands and then some they license? Is that right? So there are basically two parts to the business model?
No, I think some brands, they have a 50% stake in some of the brands that they've acquired recently, but I would say most of the brands they own fully. And then, what they do in other countries is they have joint ventures. Like in China, they have a 50-50 joint venture. So they will basically, what they are giving into the partnership is they're giving their brand and maybe some kind of advice on ideas on how they should go about using the brands. And then, the partner is putting up the stores and, doing all the manufacturing, merchandising, everything. And that's how it works. But, in most cases, I would say 90% they own the full rights to the brands.
There are some very impressive brands that they have on their roster. I mean, you have Echo Unlimited, you have Sharper Image, Starter, Rockaware, Joe Boxer. So are their customers primarily retail outlets and department stores? Is that who they basically sell into?
Yeah, they have two kinds of partners. One is direct to the retail, like the Walmarts and Targets of the world, and then they also will partner with some wholesale partners, where so some of the licenses will be exclusive for the retail partners.
I see.
Can create brands? Can you create apparel on those brands? And same for Target. So those are kind of exclusive, and they work directly with the retailers. And then they also have the other model where they work with like a wholesaler, and then the wholesaler is more responsible for working with their own partners and licensing it out that way. So about 55% of the revenue comes from wholesale licenses, and about 38-40% from the retail licenses. And then they have another small category called entertainment and other.
The brands collectively do about 12 billion in sales at retail, and then Iconics recognizes about 370 million in revenue, or roughly 3% of that, and then it has about 180 million in free cash flow, so about 50% of the revenue it recognizes. The revenue recognition, that's basically then essentially a brand license fee that Iconics charges to the retailers. Is that how it works?
I think most of it is kind of a guaranteed level. So you have minimum guarantees in place for the amount of sales their partners are going to do. So it's kind of I would say more than half, maybe 50-60%. They have visibility. They are going to get that every year, and then the rest obviously depends on the level of sales. So if the sales were to go down drastically, then yeah, their top line will also shrink in proportion to how their partners are doing. And if they have a bumper year and sales go up a whole lot, then they get a little bit of upside as well. So it's kind of a blend of guaranteed income, and some of it is kind of variable. But the good part is that if their partners do have a miss, then they are not left with inventory like a regular retailer would, where they have to discount it heavily. So that's the attraction of the business model.
Well, it's very interesting, and it seems like you really have a sweet spot in some of these retail-oriented ideas. Like Iconics, I also see you invested in Tesco and, of course, Halfords, which we discussed earlier, and also Aeropostale has been a very good performer recently for you. How do you look at the valuation there? Do you think that's reaching fair value now?
That's been kind of a mixed one, to be honest. It was one of the first investments I made when I started the business. and then it had 3 or 4 bad things happen all at the same time. They had fashion miss, the co-CEO left, cotton prices went up two times. So the gross margin suffered drastically, and there was a lot of competition as well coming in from discounting from American Eagle and Abercrombie, and then also with the unemployment in the teens and in general, that was also affecting them. So they had a really terrible 2011, probably the worst year in their 10-year history that they're in public. But it was beaten down too much. Obviously, I didn't buy it at that low price. I had bought it much earlier, thinking it was just going to keep doing what it had done for the last 10 years. And in hindsight, I made some mistakes, such as not looking at the gross margins, and which were at all-time highs, and then ignoring the impact, or probably underestimating the impact of cotton jumping up so much and all the macro things that happened, because I wanted to take a long-term view. But the good thing was I held through all of that. It went down 50%, and then from the lows of $9–10, it's doubled, and I held through that, so almost back to square one. I think it's still undervalued, but it has to do really well. It has to come back to better margins. The margins are really depressed right now. They're at about 25% gross margins, and they've done 30–35% gross margins the previous 5 years. So they need to improve their margins, and their same-store sales have been terrible of late. So, but with the cotton coming back down, that's one thing that was affecting them will go away. So I think the normalized earnings, if I look at, they can do $2 in earnings per share, and I think it's worth at least $2 billion, because they have about $2 billion in sales, more than that actually, and so if they can get back to the $2 in earnings per share, I think there is some room, probably 30–50% room more for it from here. So I'm still holding it, and I'm going to wait out this one more year and see if they can get back to their normalcy, or they're just going to be not doing that well as they were doing in the past.
Adib, before we end the interview, I just want to step back a little bit and ask you about some investors that have inspired you the most, or that you've learned from the most, either from them personally or by reading their books. Maybe you can tell us just a few investors that you think have had the biggest impact on your investment philosophy.
Sure. Yeah, I think the number one would be my brother, Adib Motiwala. So he's been an investor for probably 15 years or more in India. He was investing as a teenager, and after a few years he really took off. He's done very well. He also invests in kind of simple businesses, and has a very good idea of what kind of business he likes. So I've learned a lot from him, from his success. I mean, he's done, not exaggerating, but close to 40% compounding for about 12 years now in India and Asia, and just learning from him pretty much every day. We talk on the phone, and he helps me, mentors me on investing. So and he has held stocks for like 10 years, and he has had some 50 baggers and more, and it's from the US, it's kind of shocking to hear those kind of numbers, because you'd be happy to get a 5 bagger or a 10 bagger, and here people in Asia are doing 50 baggers, and not just one, many of them. So learning from him, like the patience part of the investing, and how to learn the business, how to follow it, and not be short-term oriented, not worry about 1 or 2 quarters, and think of investing as a business, and how a businessman runs his business. And so those are some of the ideas I've learned from him. And obviously Zeke, I already mentioned his name. He's been a great mentor for me for the last 2 years, and he's in the same town, so I sometimes go and meet him share ideas, get some feedback. And his philosophy is also, very nice. It's really easy to understand, simple businesses. He focuses on the free cash flow. That's something I learned from him, how to focus on free cash and, clean balance sheets. And also a very research-driven approach, because he has shared his how he does the research, and he follows up companies, and it's a very meticulous approach, and he writes down his ideas on paper, and he keeps them updated every quarter. And I've been following that, and I've seen the value of kind of the diligent approach of just doing the basics, reading every 10Q, every 10K, following the transcripts, and then updating your thoughts after that with an updated valuation at the end of that. And you keep doing that for a year or two, you get to know the business really well. So that's something I've really learned from Zeke.
Well, Adib, thank you very much for your time and insights.